All right. Good afternoon, everybody, and welcome to phenomgroup.com. It's my honor to have our guest of the week here, Troy Bombardia from bullmarkets.co. I've been following a lot of Troy's work since about 2016, 2017. I found it fascinating. He comes at the market from a quant perspective. You may have read a lot of his works at talkmarkets.com or visit his website at bullmarkets.co. And without any further ado, again, I want to thank Troy for taking the time to do this interview with us. He's coming to us from Canada. He's been traveling for the last couple of weeks, Dubai, Canada, all around the world. He's back at it again in the markets, delivering his research on a daily and weekly basis. You can check him out also on Twitter, at Troy Bombardia, or at bullmarkets.co on Twitter. And I wanted to take this time, basically to get him some airtime. We've not seen Troy's face in many interviews over the last year or two. And since he was formerly with Sentiment Trader and now, as I said, back at it again, with bullmarkets.co. And so, Troy, I know you've been traveling a lot. You're up there in Canada, and hopefully, you're enjoying this market here, this rally from the March low. Well, I think we're up 76% since the March low on the S&P 500. Now, okay, so off the cuff, my actual first question to you, Troy, is there was a statistic. You had done this study maybe a couple weeks ago, actually, where if the market was up, I think 75, the S&P 500 was up 75% over a certain time frame. The actual forward returns weren't as great if it was in this particular time frame.
Right, yeah. So what that was is basically saying, when it comes to understanding the stock market from a long-term perspective, as opposed to a week-to-week perspective, stocks tend to follow certain rules. One of these being, let's say, if the S&P were to rally 75 or 80% over a 2-year period, then you tend to have some major problems over the next year. So, for example, this sort of triggered in 2010 and 2011, and as we may all know, in 2010, stocks fell significantly. It was a significant correction. Once again, in 2011, stocks almost fell 20%. It was almost a bear market. Once again, this triggered in 1998. It triggered in March, which was, a few months too early before the actual 20% drop in 1998. It also triggered in 1987. And in my opinion, this was one of the primary causes of 1987. It's just when stocks overextend too much, when they rally too much, there tends to be a significant correction ahead. So this isn't to say, of course, that, in the interim, over the next few weeks or the next few months, stocks can't rally. I mean, extremes can always become more extreme, of course. But it does mean that there is significant risk in the market, and I don't think that it's wise to expect 2021 to be the same as 2020, where you get just another massive one-year rally, nonstop, very small corrections and pullbacks.
Now, I forget what the cutoff amount of days were. Do you know if we fell into?
It's not an exact day period. It's saying that within a 2-year period. So it can be, let's say, it could be 1 year. It could be 9 months. It could be a year and a half. As long as from the lows of that period, you got a rally of 75 to 80%, it's time to be cautious because most of the market's gains have already been booked in. And it's not very reasonable, in my opinion, to expect the future, the immediate future, to be just like the past.
Yeah, I look at the sentiment gauges. I look at NIME. I look at, the bull bear spread and all of this. And, for a prolonged period of time now, NIME, the active managers exposure index, has registered like 90 or above and recently got to the second highest reading of all time. And it does beg the question, given the rally, at some point these folks will de-risk. And price gets very sensitive the higher it goes without a more material, as I call it, opportunity for folks to layer cash on. So yeah, wholly agree with you there. Okay, so I want to give people a little bit of a background, more than what I've said about your traveling, of course. Um, Kind of going back to your early days, you and your family ran a private, a family fund or a hedge fund of sorts for years that did
Right, right.
extremely well. Uh,
Right. So regarding that, a lot of people look at me and they say, you're so young, you know so much. And for that, it's primarily because of, like I said, my family background, and I'm very lucky in that regards. My parents are professional traders, so from a very young age, they've been teaching me how to trade and stuff. So from 2008, 2007 to 2015, I was trading with them and helping them manage their family fund. And they did extremely well during that period. I mean, 2008, it was all about shorting the banks, shorting different banking ETFs. But the funny thing is, actually, we made more money on the long side than we did on the short side. The problem with the short side is that your time frame often has to be very quick. Um, Whereas the long side, as long as you don't buy too early, because this is 2008, of course, you're going to do well because you have very sharp counter rallies as well. So from 2009, went long stocks a bit, but around 2010 to 2015, it was a very heavy focus on precious metals. So trading gold, not so much gold, more so silver, and also trading gold miners. And it wasn't just trading, for example, individual stocks or the single no leverage ETFs. It was more so trading the leverage ETFs for silver and gold miners. So we're talking about like USLV, AGQ, which is the leveraged ETFs for silver, and NEGT or DUST, which is the inverse ETF for gold miners. And during those years, once again, we did very well. Um, and it was primarily a price action based strategy. So it's heavily about reading the price. For gold and silver specifically, it's heavily about reading into the gold and silver ratio, which is often a very good telltale sign of when trends in gold and silver are going to reverse. And these days, it's not true that much anymore, but at least from that period, 2010, 2011 to 2015, it was very much true. The gold silver ratio is very useful as a leading indicator. So then 2015, 2017, worked with my family a bit, also traded a bit my own. In 2017, focused more on my own trading, and I started bullmarkets.co. And these days, I'm heavily focused on just managing my own money. I also do manage some money for family and friends, looking into various trading strategies in public markets like stocks. Also, as we discussed earlier, Seth, looking into various investments in the private markets, for example, like real estate, litigation financing, and the such. It's a very wide world out there,
yeah.
and there are so many opportunities everywhere.
Yeah, I think investors can get kind of, when they start investing in the stock market or bond market, if you will, they start to get this tunnel vision and they
Yes.
start to create their own echo chambers, especially
Yeah.
if something's working. I
Yes.
almost kind of, when I engage new investors or new traders, I
Mhm.
often suggest to them your immediate success is usually the impediment you're going to find out down the road.
Yes. Yes. Exactly.
Because you are, when something works, it's just human nature to kind of continue down that path as
Yeah.
opposed to, broadening your horizon, so to speak.
Yes,
Absolutely.
and I think it's always very important to broaden your horizon, because nothing works forever, nothing will last a lifetime. It's always good to be one step ahead of the game so that you have a fallback option, let's say investment strategy wise or trading strategy wise, in case what you're doing right now stops working at some point in time.
Absolutely. 100%. Good stuff. All right. So, um, Troy, there are fundamentals, there are
Mhm.
technical, and there are quant-based investors and traders.
Mhm. Mhm.
What is your approach, and what would you suggest an intermediate skilled investor apply to their existing regiment or their existing process and approach to the markets?
Right. So I think to answer that question, the first and most important point to note is that there is no best strategy. We cannot definitively say this is definitely better than that. Because if there was a best strategy, I'm sure the guys at Renaissance Capital or something would have figured it out already. And when someone figures it out, when everyone does something, it doesn't work that well anymore. So it's better, in my opinion, to combine several different strategies, and mix that into one portfolio as opposed to just relying on one thing. Because any strategy, whether it's fundamentals, technicals, quant-based, not quant-based, it's going to go through its ups and downs. Nothing works equally well throughout every single year. So when you combine several strategies, and don't do too many, because if you do too many, you just end up confusing the hell out of yourself. If you combine several strategies, it'll kind of smooth out your performance over time. So of course, I don't think it's that right of me to recommend other people what to do, but I can just explain what I do. And for your listeners, they can see and think, does this apply to myself, as an example? So I have three portfolios. I split the portfolio into three parts: a long-term part, a medium-term part, and a short-term part. So the long-term part is heavily focused on fundamentals and valuations. So basically, in this part of the portfolio, I ask myself, for example, if I'm looking to buy stocks right now, I'll ask myself, can I see myself buying and holding stocks over the next, let's say, 3 to 5 year period? And of course, that's based on fundamentals, based on valuations. If I feel like valuations are too high, perhaps I won't buy and hold stocks over the next 3 to 5 year period. So given those are the fundamentals, and given that, let's say I don't decide to buy stocks, then I may decide to allocate that part of my portfolio to other alternative investments. For example, private markets. So that's the long-term part of my portfolio. The medium-term part is heavily technical based, and it's technical based from a contrarian and sentiment perspective. So this is basically saying, right now, does risk reward favor longs or bulls? And of course, a lot of times, I think a lot of traders always want to trade, and it's understandable, as you're just a human being, and it's kind of annoying to sit there and do nothing really. But that's what I do for the medium term part of my portfolio, where much of the time I'll sit there and I'll just do nothing until we get a good risk reward trade from either the long side or the short side, and then take that. And once again, this is just based on technicals. It's not about fundamentals, because in my opinion, fundamentals doesn't really matter on, let's say, a 3 to 6 month basis. So that's how that part of the portfolio works. And in the short-term part of the portfolio, it's based on some technicals, but it's heavily focused on alternative data. For example, insider trading data. So this part of the portfolio is trend following, but it's trend following specifically when it applies to stocks that insiders are buying. Because the data does show us that the stocks that insiders are buying consistently do outperform the broad index itself. So as you can see, when you combine a long-term portfolio, a medium-term contrarian portfolio, and a short-term trend-following portfolio, all of which use different strategies, your returns are going to be smoothed out over time. So to answer your question about, like, if I were to give an advice for a medium-term investor, I think the best thing a lot of people can do is try to quant out your strategy, so to speak. Like, a lot of people, they have a strategy in their head, or they'll do a strategy that's discretionary based. But if you explain that strategy to me, I can very easily explain to you how that strategy is very similar to XYZ quant strategy. So what ends up happening is the difference in returns between your discretionary strategy and this quant strategy is very minimal, because every human, really, even a discretionary strategy, you have various rules that you're following in your head. It's just you haven't written down those rules. So when you do quant out a strategy, you end up saving yourself a lot of time, and you do also clarify the strategy in your head, so that when things get confusing, when markets get confusing, it's good to go back to those baseline rules and say, okay, this is what the baseline rules are. Here's how I should act. Here's how I should put my emotions aside.
Yeah, totally agree. It sounds like, if I was to kind of sum that up a little bit, would be, just as you wouldn't marry a stock, don't get married to one particular strategy.
Exactly.
Just as you want to be flexible, with the market, be flexible with fielding and testing other strategies to see
Exactly.
if it's something that fits, because not every strategy, even if it works for, John Q, it may not work for Sally P,
Exactly.
because of our, makeups, our dispositions, our risk tolerances, and where we are in our stages of our investing careers.
Exactly.
Yeah, good stuff. All right. Let's see here. Every investor and trader, and this is one that a lot of people don't like to talk about, but every investor and trader undergoes difficult times in the market.
Mhm.
What was your most difficult experience, and how did you manage it?
Yeah. So the most difficult experience for myself, this is back in 2015 when we were still trading heavily silver. And 2015 was more so about gold miners for us. And so, 2015 gold and silver, including gold miners, were falling heavily. And at that time, we were primarily employing a price action based contrarian strategy for the precious metals markets. So, gold and silver was falling, gold miners were falling, and we went long. But we went long earlier by, a few days, and we went long NUGT, which these
Like
days
a
not that
leverage.
many. Yeah, NEGT is a 3x leverage gold miners.
Okay,
So
yeah.
out of these three markets, gold, silver, and gold miners are already the most volatile of these three markets. And then we went long the 3x version of gold miners. So, a bit too early, in a matter of days, down like 30%. And back then, it was more of like an all in, all out strategy. So it wasn't, we wouldn't a lot of traders would allocate, let's say 1%, 2%, 3%, 5%, 10%, whatever, to each position. We didn't do that. We would only trade, let's say, twice or thrice a year. And every time we did trade, it was all in, basically. So basically, the entire portfolio in a matter of days was down 30%. And I'll tell you, it was tough. Um, because unlike stocks, gold and silver, and including gold miners, because gold miners really is just a reflection of gold and silver. It's not that anchored to fundamentals. There aren't that many fundamentals you can anchor it to.
Right.
Whereas for stocks, for example, you can anchor to valuations and stuff like that. So it's just sweating buckets for days.
Was
And
this
eventually,
August, September? Was this like later in the year, in the fall?
yes, yes,
They
yes.
start
It was more so the second half
yeah.
of 2015.
The China yuan
Yeah,
devaluation, hard
yeah.
landing rumors, and
Yes, yes, exactly. This is more so middle to late of 2015. Um, so of course, eventually gold and silver went up. We held it, but one of the biggest lessons from this is it's not just at the end of the day about how much money you make. I mean, unless you plan on buying a private island, like Mark Zuckerberg did, then it's just as important to sleep well at night, to trade in a proper mindset. And really, when you have a huge position with huge leverage, it doesn't help you do that. Like my mentor my mother, who is one of my life's greatest mentors, used to always say, you need to be able to hold your position until you're right. And this is very important. And I think it's a point that many traders miss out on. Look, like your market outlook at the end of the day could be right. But in the interim between now and then, when you are right, the market might do something that goes against you in a way. So if the way you structure your trade, let's say you use futures, and this is the reason why I don't use futures, if the way you structure a trade is not so favorable and you cannot afford to hold on to that position until you're right, well, then you must change the way you structure your trade because it's just, if you get stopped out, well, you're done. Like you're still done. It's too many investors and traders. Let's say they put on a trade. It turns out they're right in the end, but in the interim, something happens and they get stopped out at a loss or whatever, and that's it for the trade. So reduce your size. Don't be too greedy, which is what I learned from that time. And also from that time, I learned it's better to trade markets where there's more of an underlying logic. And this is the reason why I don't really do gold and silver that much anymore, because price action can always change. Price action that applied from 2011 to 2015 can change from 2016 to 2020. And you don't really know that the price action has changed until it has already changed and what you're doing has already stopped working.
right.
So,
Yeah, it's funny, the saying, timing is everything is like
yes,
prioritized at the
yes,
top, whereas it seems to me position size should
yeah.
be, at the top of that
Right.
echelons, if you
But
will.
but but speaking about position size as well, plenty of people. I mean, for most beginner traders, this is what they hear: don't risk more than 2%, don't risk more than 5%, don't risk more than 1%. Like that's the generic line that all the traders hear, and I think that is correct if you're just getting started in trading, because you don't want one mistake, blowing you up, and that's it. But over time, I don't think there's anything wrong with very heavy position sizes, because for example, I hear this all the time. Oh yeah, great, I made 20% on this trade. And then you ask the person, okay, so what was your size? It was 1%. So you're telling me that you put in all this effort to make 200% off of 1%. You know what I mean? Like,
Right,
you
right.
really have conviction in my, and everyone's different. Everyone's strategy is
Well, it's
different, but
about leveraging your expertise. If you've started
yeah,
a strategy, leverage that strategy, leverage the knowledge.
exactly. Don't keep trying to find new things. If you have a really good opportunity, why would I waste my time and go find 20 other new things, right? I'll just really leverage my knowledge in this one opportunity and really push hard on it.
Yeah. And
Yeah.
the reason why in telling your story about Nugget there,
Mhm.
in hearing 2015, it automatically harkened. I think we were in the same situation, just in different complex
Right,
areas of the market. I trade volatility, that's my
right, right.
expertise. And back
Understood.
then I was 2x UVXY short.
Right,
And
right.
all of a sudden, as you were saying, you don't really know that you're in a market shifting dynamic
Yes,
until
yes.
price has already shifted and starts trending against you.
Right.
And same thing. My story is, my wife in the background, honey, come here. I want to show you this refrigerator. We need a new refrigerator. And I've been sweating bullets now for a couple of weeks. I'm down 30. I was down I think I maxed down about 58% in
Right, right,
my leverage short volatility positions. And in the
right.
background, I've got refrigerator, appliances,
Right, right, right,
decisions
right.
to make. And I'm like, do we really need that refrigerator?
Yeah,
As I'm watching, portfolio balance each week, kind of, and
right.
but yeah, that's why I was like, wait a second, was that August, September time frame somewhere
Right,
around?
and I'm not sure if I'm recalling this correctly, but one of the things with UVXY in 2015 and 2016, at least with Interactive Brokers, which is the brokerage that I use, they had changed their margin. They
Yes,
had changed their, and that one was a big problem for a lot of people because
right.
they had put on a trade in a certain way, assuming that you could have a certain amount of margin, and then last minute when you need it the most,
Yep.
they change the rules on you, and then you go like, oh shit, what do I do now? So.
It's fun, there's a lot of nuances when it comes to whether if you're trading commodities and futures
Right, right,
or leverage products that have their,
right,
the assets under management, which are futures. Uh,
right.
there's a lot of that, those kind of nuances that a lot of people didn't know back then and didn't
Yes,
know in 2018,
right, right.
whereby like Interactive Brokers, I still, have an account with them because
Mhm.
of, certain trading parameters that they allow, which other brokerages don't allow.
Mhm.
But when it came to volatility trading, I would never use them simply
Mhm.
because of those margin requirements and the fact
Right.
Interactive Brokers has a very stringent risk management department.
Mhm.
So if they felt that they were at risk,
Yeah,
they
exactly.
would force close a lot of
Yeah,
positions without
yeah,
even, talking to the account
yes,
holder. You just
yeah, yes.
go there one day and all of a sudden, where'd my position go? And
Yeah, they throw you under the bus first before they got hit.
exactly. Yeah, they would do that. So, and that's some of the things I try to warn folks about when it comes to,
Right,
research your broker, know who your broker is and what their practices are and things of that sort, especially if you're going to be on margin under those.
right, right, right.
All right. So, last year,
Mhm.
walk us through what you were analyzing in the markets back in March,
Mhm.
March 2020, as markets were basically breaking down. We had limit down days. Like,
Mhm.
what were your thoughts and how were you evaluating like your daily process back then?
Right, right. So thoughts are just as important, I think, as how you position your portfolio, because at the end of the day, that's what matters, right? How much money you make. So basically, going into January, this is like by early January of 2020, I was I wasn't exactly short the market. What it was is I was bearish on the market. See, it's funny now that you ask because 2020 is in similar ways. You can see the similarities between 2020 and this year. But
Right.
this year, of course, it is much more extreme than it was a year ago, where you're getting a sense of investors are very euphoric, sentiment's very high, and it's all about growth. It's about growth at any price. It doesn't matter earnings. But like I said, last year wasn't as bad as this year. So by January 2020, that was the general sentiment that you could feel. And when you get that sort of sentiment, what typically happens is it's really just you don't know what the outcome is going to be. You don't know if, let's say, stocks are going to fall because, let's say, sentiment's high or whatever. But on the other hand, extreme can always get more extreme. So when you get very powerful moves in the market, that's always the problem, is that you don't know which one of these is going to overpower the other. Strong momentum, that's going to lead to even more strong momentum, or a correction and a pullback, which is typically what people would assume when you have high sentiment. So basically by January 2020, I had positioned myself so that I was 25% long stocks and then 75% long bonds. And the reason behind this is, first of all, if the stock market drops, of course, well, your long bond position is supposed to offset most of the losses in your long stock position. But I think just as important, the reason why I had held 25% long stocks is because when the market goes higher and higher and higher, and you see this with a lot of people, they get that feeling of, oh, I missed out, you know. So then when you start to get that feeling, you are no longer acting rationally, you're starting to act based on your emotions. So you end up chasing the market higher, which is, I mean, if you weren't going to buy it, let's say at 3,000, would you, in a logical perspective, and if this is not a momentum-based strategy, would you buy it at 3,600? You wouldn't. So when you have, let's say, a small position still in the market, at least it anchors your trading psychology. It makes you feel like, okay, so I'm still participating in the gains. I'm not participating that much in the gains, but you know, at least I'm participating some, so I don't feel the need like I'm completely missing out on this rally, and I need to chase it higher and higher. So at first, you know, similar to a lot of other people, when I first heard about coronavirus, I was like, okay, this is just another Ebola thing. I wasn't paying that much attention to it.
I was debunking videos coming out of Vietnam saying they were coming out of China.
Yeah,
I mean, I spent hours at the Money Show. You might be familiar
right,
with the Money
right,
Show.
right.
Basically, we have proprietary software that we can load up any video archives
Mhm,
and basically find where spots of editing have been done, the
mhm,
geoprint locations and things of that sort. So we have
right,
our own booth at the Money Show, and
right.
hedge funds were like, "Here, dude," because they wanted to know what was real because
Mhm, yeah,
they're at risk, they're leveraged, and they wanted
right,
to know what was real. And there was this one video that came out of Vietnam,
right,
but it was circulating all over Twitter. It was the most popular one on YouTube, and when
right.
we fed it into our software, it came out with Vietnam.
Mhm,
And then when we like really closely looked at the video, because it was supposed to be an apartment complex in China. And I'm sorry, I
right,
know I interrupted you, Troy. I'm sorry.
right.
It was supposed to be an apartment complex in China.
Mhm,
But when we were able to focus in, because there's these red like things above the door,
mhm,
it said 203. So
mhm,
it was
mhm,
apartment 203. And then when
mhm,
we kind of looked at some of the other finer points, like
mhm,
it was a picture, it was a video of supposedly the Chinese government like
mhm,
pulling this family out of their home to go into
mhm, mhm,
quarantine or something.
mhm,
And
mhm,
they were all in hazmat suits, and the family was, each member was being pulled out.
mhm,
Yet every member was wearing shoes, like all dressed up, ready to go. Then there's
mhm.
the number 203,
Right,
on top. And
right,
like I've been to China before, and most of the
right.
places that I go,
Mhm,
all the doors would swing a certain way,
mhm, mhm.
and this one was swinging the exact opposite.
Ah,
Like I
gotcha.
put all these things together, and I'm like,
Mm,
and this was before Edward, my partner, gave me the readout and everything with the geoprint location,
mhm.
and I was like, and then when it showed Vietnam, I was like, man, and everybody's freaking about it. And this was January, everybody's,
Right,
so
right, right.
yeah, go ahead. So yeah, you didn't know what coronavirus was either back then.
Yeah, I mean, for many people, it was, I mean, look, before the idea of a pandemic was something strictly reserved for movies, right? Where you think about end of the world,
Yeah.
zombie apocalypse, or something like that. But it turned out to be real. So basically, going into the crash, I was heavily long bonds. So that part of the portfolio, like, pretty much offset the losses from stocks. But basically, throughout March, when it became apparent that, this is not just another Ebola scare, this is something that you actually need to very seriously pay attention to. I was thinking that this could be the bear market. This could be the recession that resets the cycle, because we just had a 10, 11-year bull market, longest economic expansion in history.
Yeah.
Our world is very much loaded up on debt. Perhaps this is the thing that's going to very hardcore reset everything, which is a fantastic opportunity. I mean, it resets the whole cycle. You buy in at the bottom or near the bottom. In the first year, you make 50, 70% on that post bear market rally. Fantastic opportunity. So, but one of the biggest things that 2008 had taught me was you need to constantly scale into one of these major crashes. It's not such a good idea to say, okay, I think this is the bottom. Let me go all in at this point. Because the reality is, like, everyone will tell you with 2020 hindsight that I caught the bottom, right? Everyone will tell you that. But in that, when you're actually in that period of time, it is very, very, very hard to know where the exact bottom is. Because when the market is just completely flooded with emotions, no one is going to know. For example, 2008, okay, it could have bottomed at, let's say, 900, it could have bottomed at 800, it could have bottomed at 500. People were calling for S&P 500. It just so happened to bottom at a specific number, 666, right?
Yeah.
Yeah, exactly. Like
The Mark
only,
Haynes bottom as well.
yeah, so only with 2020 hindsight do you know where the exact bottom is. So what happens is if you buy too early, of course, you're just buying halfway throughout the crash. And you're going to panic along with everyone else
Yeah.
as the thing keeps going down. So in my opinion, it's better to constantly scale in. So what this does, of course, is if let's say you scale in 4 or 5 times, okay? Let's say you have a 100% portfolio, you break that into five parts, 20%, 20%, 20%, 20%, 20%. If, let's say, the market goes through your first 20% and goes through your second 20%, and then it reverses, you're not going to be fully invested, right? That's just something you're going to have to accept when you take this strategy. But if the market keeps going down, well, you're not going to feel that bad because you're constantly scaling in, bringing down your average entry price. So at the end of the day, once again, it comes back to what strategy can you sleep with at night?
Right.
If you're doing something that's making you sweat buckets, well, you should probably be doing something else. So going back to March 2020, I was scaling in, didn't manage to get completely long. The market went up, and see, this is what I mean. This is what I mean by market structure is very, very important, and it's important to pay attention to this because it impacts how you're going to change your trading strategy. Well, what I've noticed since 2017 is that the market has consistently gone in one direction.
Yes.
For example, 2017, you get one massive rally throughout the whole year. Plenty of people calling for a correction and pullback, very, very minor pullbacks along the way. 2018, Q4, we had a sharp decline,
Yep.
and then the 2019 rally. So typically when you get a crash like you did in Q4 2018, and then you get a rally, you expect the rally to retrace, let's say 50% to 61.8%.
Right.
That was the norm from 2000 to 2016. But of course, 2019 didn't do that. It just went straight back up in a straight line, right? And then late 2019, early 2020, before coronavirus, you also had the highest rally, the sharpest rally, the highest sentiment of all time. And then once again, in March, you get the sharpest crash of all time. And then after March, you get, once again, the sharpest rally of all time. So what it makes you realize is that, first of all, if you're going to use certain types of strategies, for example, sentiment-based strategies, you must increase your bands. Like before, let's say you were bearish when sentiment hit 70 as just random number. You were bullish when sentiment hit 30. You need to increase your bands. Now you need to say, okay, I'm only going to turn bearish when sentiment reaches 80, and I'm only going to turn bullish when sentiment falls to 20, because markets are consistently getting more extreme. And of course, throughout this call, I think we'll get into it later on about why I think that's happening. But that's one of the biggest lessons for myself, at least, from the coronavirus crash.
Yeah, and you had mentioned that everybody says that they pick the bottom afterwards.
Yes. Yes.
One of the things that I think you also hear is I was short into the crash, and
Right. Right.
when you go back and you look at we'll just use the benchmark S&P 500,
Right. Right.
because you see it wasn't in a straight line. You would
Right.
have those limit down days
Yes.
followed by a bounce of 5, 7, 10%.
Yes.
And
Yes. It's very nerve-wracking.
exactly. So
Yeah.
I can't imagine. Maybe you were short for that first wave, but then when
Right.
you got that 110% up day, I can't imagine very many people said, no, it's going to go back down again. And then
Right.
it does. And then
Right.
again, you have that very sharp reversal the next day. And, so the two things that I tend to stay away from is whenever I see somebody say, well, I called the bottom or I was short into that, I kind of say, man, you have got ice water in your veins and you are like the Incredible Hulk. Cause I tend to be, I participate in the more, the most volatile part of the market being future
Right.
volatility complex. If I
Mhm.
couldn't do that,
Mhm.
it's hard for me to imagine that
A
somebody
lot, a
else.
lot of people who tell you they call the bottom, and it's funny what you'll see them do is they call the bottom from -10% all the way to -30%.
Yeah,
And they call the bottom every 2% down, and then later on they'll show you their one call from the bottom. It's like, yeah, I'm
right.
sure you did call the bottom, but so did you call the bottom every 2% down from -10%.
Yeah, exactly. Something I took with me. I was a student of my father as well, and
Right.
my father said, "Son, you don't got to call bottoms. You don't got to call tops. If you're
Yes.
within 10% of that range,
Yeah.
you're doing just fine. Just take chunks
Exactly.
out of the middle. You know."
Exactly. Like, what is that phrase from Remnants of a Stock Operator? The final eighth is the most expensive one. Because when, there's a psychological attractiveness to calling the bottom and top. It makes you feel really smart. It makes you feel like you're the guy who did it. You're the guy who's in the know. But, I think it's better sometimes to be a bit more humble and to just admit that it's hard calling the top and bottom. And let me make the easy money and focus on the easy money.
Yeah, from a at phenomgroup.com, because we do macro research reports,
Mhm,
technicals, fundamentals, geopolitical, you name it. It's all
mhm,
baked into our weekly research report.
mhm,
And we moved to the sidelines in
mhm.
March. We just said we don't know how bad this is going to get, and we don't
Right,
need to know
exactly.
how bad this is going to get.
Exactly,
We just need to get
exactly.
through it and to the other side.
Yes,
And
exactly.
once we got to the other side, we
Mhm,
realized, okay, now we can look at technical indicators of what happened to
mhm,
produce kind of that flush there on like the Friday, March 22nd, that
mhm,
produced that flush. And is that something we've seen in the past? Is
mhm,
there, indicators that line up with past deleveraging of that
mhm,
amount that
mhm,
could indicate that at least a potential bottom is in?
mhm, mhm.
But even then, you don't get married to it. You just say,
Yeah.
okay, we've identified something that could be a potential bottom.
Mhm,
Tread cautiously, be open and flexible to new information that is going to come out over the coming
mhm,
weeks and months. And
mhm,
to kind of harken back to what you said so far as sentiment is concerned, uh, and this market kind of just keeps going higher.
mhm.
Uh, and widening your bands, I really like that. That's a very that's a diamond right there, if you ask me.
Mhm.
Because I also come at it from the perspective of there's not a lot of fiscal moral compass, if you will,
Yes,
in the world anymore.
yeah, exactly.
So that
Yep.
has to be that plagues. Well, I shouldn't say plague. It weighs. It
Yes.
weighs as a part of the overall sentiment picture.
Exactly. Like before, 10 years ago when they go, oh, let's say you went long 10 years ago and then people, you get the snarky comments like oh, the Fed is whatever. And back then I would just kind of like brush that off. But these days, it really is impossible to ignore what central banks have done. It's just, I mean, when you think about it, certain things central banks have done over the past year, even 5 years ago, would have been unimaginable.
Yeah.
But it is the world we live in. There's no point, complaining about it, talking about it. It is what it is, and you just need to deal with it from your portfolio's perspective.
Right. I often say to people, well, they'll market to market when they have to. I just don't know when they have to. So,
Exactly, exactly.
all right. If there was only one thing you would suggest the average investor to add to their process going forward, based on just some of the things we've talked about here, what would it be and why?
So if you don't mind, I'll actually suggest two things. The
Sure.
first thing, and we've kind of touched upon this already, is an open mind. So it sounds kind of silly, but it is very, very important. It's actually very, very hard. P- so, and it's hard for different types of people. And it's especially hard when you already have a strategy that works. And you had kind of touched upon this already again. So when you already have a strategy that works, it's very easy to get comfortable to say, this is doing fantastic. You tend to extrapolate what happened in the past going into the future, right? Like I made X, Y, Z% over the past. If I just make X, Y, and Z again going 5 years forward, and the strategy looks like it's doing perfectly fine, why touch something that's already working? So instead, it's better, I think, to keep an open mind and to look into different things that you haven't done already, to look into different trading or investment strategies that you haven't done, so that one day, if there comes a day when what you are using or strategy you're using doesn't work anymore, well, you have another strategy as a fallback, as a backup option, as opposed to like you're using a strategy and one day it stops working. Well, what else are you going to do? Right. So, like I said, having an open mind is very hard, primarily, I think, for that reason, and it takes work because we're all human at the end of the day. Everyone wants to do less work. Like if I had a strategy, I didn't have to do anything. I could just make 100% every single year. I'm not going to do anything else. There's no way I'm going to do anything else, right? So it's better to always try to learn more and spend that extra effort. What a lot of people do, I find, is let's say they have a strategy. Okay, let's say the strategy gives you an average of, I don't know, 15% a year. They try to constantly tweak and refine that strategy to make that strategy go from 15 to 17% a year. But when you really think about it, it violates the 80-20 rule because you're putting in all this extra effort and an additional 80% effort just to give yourself an extra 20% of results going from 15 to 17. So is it not better to instead take that time, just be like, okay, so my strategy's okay. I don't think there's a lot of things I can do. And for all you know, when you're tweaking a strategy, you maybe just curve fit in the strategy. Maybe it's not actually better in real life, right? It's not better to take that additional time and go figure out a new strategy, something that can diversify your portfolio. So that's the first thing I would recommend. And the second thing, once again, is just learn how to code. I mean, for myself, I think it's been very beneficial. Um, you can test out different strategies, like I said. And a lot of us, I mean, every human being really, you come into the markets with various preconceived notions. It's how the human mind works. So when you quant out a strategy, when you code various strategies, you're essentially testing these theories in your head. Does it actually work? Does it actually stand up to the light of data? As opposed to, I think in my head that it works.
Right. It takes a lot of time out of
It
the
does.
exercise for
It
sure.
does. It does. It definitely does. Yeah.
Okay. Whether I like it or not, the phrase "it's different every time." The
Mhm.
circumstances from one market or cycle regime to the next are often quite different, but the
Mhm.
market tends to be guided by history as it expresses human behaviors
Mhm.
that are typically the constant variable. Human behavior takes far longer to change and adjust. Is there anything in the quantitative data that offers when such behaviors are maybe shifting that you look for?
Mhm. And that's a great question because typically you end up getting two camps. End up getting the camp that this is always different, which is also true, and you also get the camp that it's never different this time or whatever, which is also partially true. So as usual, the answer is somewhere in the middle, and the way to look at it, I think, is when you consistently get various long-term indicators that are showing you this is very different from the past 10 or say 20 years. And it's not just one indicator telling you this, it's many different types of indicators telling you this. Well, then you need to consider that today is indeed very different. We're in a very different market structure than the past, let's say 10, 15 years. And going back to the example that I had brought up, right now you're consistently seeing these indicators telling you, whatever option speculation, this type of speculation, that type of speculation is the craziest we've seen in the dot-com bubble, right? And it's like I said, it's not one indicator, it's many different types of indicators telling you the same story. So at that, and once again, like I said, you can see that the market since 2017 to present has been very different from the market from 2016 previously to 2000. You're getting much sharper movements, much more elongated and more extreme movements, and fewer of these short-term counter-trend movements, right? So when you combine the difference that you're feeling from 2017 to present with these various indicators that are telling you this is the craziest whatever that we've seen since the late 1990s, well, then it's pretty obvious, in my opinion, that we're in a different market structure. Um,
Right.
and of course, that type of market structure is, and it should impact the way you trade. If you keep trading the markets the way you did from 2000 2016 versus 2017 to 2021, well, your returns are going to be very different because, like I said, no strategy works equally well in all market environments. Some strategies work better in some environments, some work better in other environments. So if that's your thesis, if your thesis is, let's say, the market structure, the world is very different now than it was even just 4 years ago, right? You're going to want to ask yourself, why have things changed? Why have we, for example, progressed into a more 1990s like environment as opposed to 2000, 2016? And I think, at least in my opinion, there are two main factors. The first one being social media. I mean, these days, it's undeniable. Everyone's on their phone. They're looking at Facebook, Twitter, Reddit, YouTube, different, and I guess not Instagram so much, but those are the primary platforms. And what these platforms do is they're a giant echo chamber,
Yeah.
right? I mean, that's by nature, these platforms are designed to be that way. Something popular constantly gets more and more popular, and things that aren't popular, well, they get drowned out by the sea of noise. So when you think about that from market's perspective, what it does, it extends trends. So before, let's say, you read something in the newspaper, or something only gets so popular. These days, everyone and their best bud on Facebook and Twitter is talking about something. So once something gets popular, more and more and more people hop on the bandwagon, and that extends trends both up and down. So when it's going up, everyone's going, oh shit, what stock do I buy? What do I buy? What do I buy? You're buying this, I should buy that too. When it's going down, you're panicking, you're panicking, you're panicking, and everyone's panic feedbacks on each other, and it makes them all panic even harder. The second thing I think, and this is more of a long-term one, it's we live in a very unstable global environment, very unstable. And this is why I think you're getting this thing where everyone's emotions swings in one direction and something changes. Let's say coronavirus comes out. And then all of a sudden, everyone's emotion swings in the other direction. And then something changes. Central bank action comes in. And then immediately everyone turns on a dime and everyone swings like crazy in the other direction. This to me is a hallmark of a global society that's very unstable, where people are fundamentally very nervous, right? I'll give you an example. Um, right now, what I'm thinking, and this is just a thought, one of the things that could push the markets down, and it's not going to happen right now, of course, is if, for example, the new Biden administration decides to increase taxes, whether it's corporate taxes or income taxes.
Yeah.
And this is a topic that's not talked about very much right now. So if it becomes a thing, then everyone who's long is going to all panic at the same time, and they're all going to sell at the same time, and then you're all going to get a sharp sell off. It's just like I said.
Will demand negative Fed fund rates.
Yeah, yeah, exactly. Like what's happened really is there's a lot of excess and a lot of instability that built up as a result of the 1980s, 1990s, 2000s, and of course in the 2010s, the government basically just kicked the can down the road so that we can deal with the problem in the 2020s.
Medicine for you, yeah.
Yes, exactly. So now this instability is basically a result, in my opinion, of all the accumulated problems that we're all pushing into this one decade that we need to deal with as a world.
I can't disagree with you, unfortunately. While I appreciate good times from a capital market perspective,
Mhm.
you do have to, sometimes step back and look at how you got here.
Yes.
It has taken, unprecedented amounts of liquidity,
Mhm.
unprecedented fiscal debt,
Mhm.
and that speaks to somewhat of a moral decay of society and government
Right, right,
involvement. And from that
right.
standpoint, it does find its way into the market. It's just a matter of
Mhm.
being able to appreciate it, as you say. Or as you kind of hinted at, and maybe I'll paraphrase. Um, know that the roller coaster does come to a stop.
Yes, yes. But
There
at the
is a
same time,
point. You just don't know where it is. Um,
yes.
how long do you want to stay on that roller coaster?
Mhm.
And, how inebriated do you want to be while you ride that roller coaster? And
Right,
kind
right.
of like how much leverage or how much
Mhm.
exposure do you want to have to this market, knowing that at some point.
Right. But at the same time, I think while you think about these things, don't think about it too much. Otherwise, you'll end up being like those guys who just philosophize all day long
Oh yeah,
and you go, how does it actually impact your trading? So from a trading perspective, once again, it's just routing trends is very important in this era, in my opinion, because a trend can always get more extreme than you initially thought. And also, if you're going to use, once again, contrarian indicators, for example, sentiment, you must widen your range. Otherwise, you cannot assume the same range you did 4 years ago as you would today.
absolutely.
Yeah.
Um, kind of a personal question. Who is your who's that guy, or who's that fund manager? Who is that maybe mentor? Who is that person that if they say XYZ,
Mhm.
you're like, okay, because this market participant's track record is just that strong historically, and it gives you kind of that boost of confidence,
Mhm.
if anybody at all.
So I don't follow that many people, that many of the talking heads on TV, but one of the main guys I would say is David Tepper. And it's primarily just because I've followed him for over a decade, and his calls primarily at the key turning points in markets have been pretty spot on. And you always got to be careful of the perm of some things, whether it's the perm bulls or the perm bears, because really you might as well not listen to that at all. But he's been flexibly bullish and flexibly bearish, and once again, his timing has been pretty good. Like, I'll just say certain people I wouldn't quite follow. Warren Buffett, he'll always tell you buy America, uh, which I guess is right from a very long term perspective. But as a trader, it doesn't really help you that
Yeah,
much.
yeah,
Um, yeah, so I wouldn't quite follow him. David Tepper is quite good. Ray Dalio is really good, I think, in the sense of understanding the world. I wouldn't quite follow him on his market calls though, because
yeah.
not very accurate there. Let's just put it that way.
The all, what is it? The all weather
Yeah,
portfolio. Yeah,
yeah. That
alpha.
one I think primarily has benefited from the fact that it's been a 40-year bond bull market,
Mhm.
and once if you don't have a 40-year bond bull market, well,
Right.
that's not going to do so well.
Yeah,
So yeah, just off the top of my head, David Tepper, I would say, is the best person to follow on TV.
sounds good. Now you had briefly touched on social media there for a second, so I'll ask you,
Hmm.
kind of a blanket question.
Hmm.
Twitter, Facebook, Reddit, social media, stock twits,
Hmm.
good, bad, or ugly? How would you characterize it and maybe explain it?
So my opinion of social media has changed over time, and I don't have that strong of an opinion. I can just say what I'm doing. So for myself, I'm trying to get off social media as much as possible, tweet less. I spend less time reading other people's stuff on social media. And going back to it, it's primarily just because social media is designed to be a giant echo chamber. So what rises to the top isn't necessarily the best idea. It's not the best strategy. It's not the best anything. It's the most popular idea. And in many cases, not just in finance and trading, just anything really. Look at what's most popular on YouTube. Okay, it's a lot of the most funniest stuff. Popularity is not usefulness. Let's just put it that way.
Funny, embarrassing. Yeah.
Yeah, exactly. Like there are ways to be funny and popular and whatever, and I don't know, it's not that actually useful from a trading perspective. So, very simple example on social media, what works best is hype. And it's true of any type of social media. That's why, let's say, the online marketers will have the Lamborghini in the background, they'll have the private jet, whatever. That's what attracts people's attention on social media. And because what's shown to you is decided by an algorithm, that algorithm is based on what's popular to other people.
Right.
So, in general, spending a lot of time on social media, you're going to hear the same thing over and over again. You're not going to learn a lot of new things. Which is why, in my opinion, especially for new people, for new traders, what happens is you're just confused. Like you're just super confused because you're getting different ideas coming at you from left, right, and center. You don't know who's right. You don't know who's wrong. It's just a giant hodgepodge of information. So I would say in general, spend less time on social media. Spend a bit of time reading books. Not too much because once you read enough books, you come to realize everything is the same. Like you hear the same trading advice from this book to that book to that book. It's all the same, really. And just spend more time, I think, sitting, reflecting on your strategy, trying to improve it, and just working calmly and quietly. And also, the other thing I would say is a lot of the best investors and traders, not just in, let's say, public markets like stocks, but in other markets as well, they're not quite on social media. They're too busy, let's say, managing a fund or something to, spend a lot of time tweeting a day.
Right.
So, so.
Yeah. I'm not a huge fan of social media from the context of uh, what tends to draw attention and get the wider audience, if you will, tends to be that which drives sensationalistic
Yes.
ideas and
Yes,
or
exactly.
fear, because that is what, if we're speaking from an investor standpoint, well, my primal fear is losing capital.
Yes.
So if you tweet this out or post this kind of be careful message or chart about a
Mhm,
potential doom and gloom scenario,
mhm,
that's where people gravitate to, because that if I know that information, I can
mhm,
avoid losing the capital.
Yes, yes.
And I tend to see a lot of that on even financial media networks,
Yes, yes,
and
exactly.
charting, if you will, but from the context of the people that they bring out, special
Yeah,
guests and whatnot,
yes.
calling for a 10% correction, a 20% correction, as opposed to, here's what you should be doing if,
Yeah.
here's how you can benefit from it. The context is always hyperbolic or sensational as opposed to educational,
Mhm.
when these types of situations arise. Nobody knew what to do when we were limit down days,
Mhm.
and the government was issuing stay-at-home orders, and the market was down 20%.
Mhm.
In 17 trading days, like the broader public didn't have an idea of whether or not they should just vacate their
Mhm.
holdings or not, because that hasn't been the modus operandi of the financial news networks. And
Right.
I guess, from that standpoint, I'd like to see more of that and less
Right.
of the calls,
Yes, yes, exactly. And like you were saying, and it's not just a problem limited to social media. Like even these days, I try to reduce the amount of stuff I read on the media itself. Um, and people like, for example, the talking heads in the media and social media, a lot of them, they don't have skin in the game like you and I. They're just here, like, I mean, they're getting paid, and you understand it. They're getting paid to sensationalize. I mean, that's their job basically. Like one of the reporters, and I'm not going to mention the name, this person's like tagline was "I talk," and I'm thinking, I'm sure you do talk, but that's all you do, and it's not that useful, really. At the end of the day, what matters is just how much money you make. It's not this and that and this and that. It's okay. How do I synthesize all this stuff down into one coherent trading or investment decision?
Right.
And a lot of times, less is better than more, in my opinion. So.
Totally agree. Totally agree. Well, I got to thank you, and hopefully you can come on again. I know you've got a busy, remainder of the year, and hopefully when the rest of the world opens up and we can travel more freely,
Right.
we can get together in Dubai. But between now and then, Troy, big thank you from Finom Group,
It was
and
my pleasure.
I wish you all the best. Wish you all the best.
Okay, okay. Well, thank you for having me on. Thank you for having me on, Seth. It really was my pleasure. And like I said, I'm very jealous. You're sitting in sunny Florida, and
I
here I am
sure
in Canada.
am.
Yeah,
70, oh, no, 81 degrees.
yeah, yeah. And yeah, and here minus 11 degrees Celsius. So I'm very jealous right now.
Uh,